p.m. Welcome, everyone. We stand for the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. If I can have everybody do a roll call, we'll start with David at the end for attendance.
Neil, present.
Here.
Dave Petoskey.
Michael Shostak, Treasurer.
Jason Tice.
Rena Emmons.
Thank you. Any public comment? Seeing none, we'll move on. Would like to approve the minutes from August 6, 2025.
Second.
Support.
All in favor?
Aye.
Aye. Any opposed? Hearing none, they're approved. We'll turn it over to for quarterly portfolio review. Do you have any comments? Brian. Okay.
Oh, I'm sorry. Let me start with the operating reserves. Thank you. So in the packet is my quarterly treasury report. I'll just update the committee that we have, as of September 30th, we had just over $100 million in operating reserves. We keep a little over $2 million in our checking accounts. We have $6 million in money market funds, which include the J.P. Morgan sweep, as well as the money market at PNC, which is our custodian. We have 2 bank certificates of deposit that total a little over $7 million. We're in 2 local government investment pools. One is MI Class, which is a pretty well-established private firm that manages institutional money here for public sector clients in Michigan. And then we also participate in the Oakland County local government investment pool. And right now, MI Class is yielding higher returns because they have more of a short-term focus, but as short-term rates come down, Oakland County actually has a duration closer to a year, whereas MI Class is closer to 30 days. So as those rates start to shift a little bit, we may see Oakland County providing the better rates. And Oakland County does provide next day liquidity. So it's still a liquid investment. And then finally, we have our bond portfolio of about $43.5 million, which is held now at PNC Bank, which is the custodian that we switched to. And we hold a combination of Treasury and agency bonds. So overall, the township is in a very strong and liquid position, able to meet all of its short-term and long-term obligations. So that's my report on the operating reserves.
Pension, Brian.
Perfect. So change my jokes a little bit for Michael and Jason's benefit.
Were they good? Because we want to hear them. We don't want to be left out.
I didn't get the red light. I didn't get the hook. I'm going to start with handout, and I realize I'm kind of violating the rule of typically. Those that work in our industry know that when you bring colorful charts and graphs, it's because you're trying to distract your client from bad news. I don't have bad news. I have good news. But the chart and graph, this graphic is to explain the reasoning why I have good news, not great news, right? And what's that distinction? We had positive numbers. They just underperformed the benchmark. And what's funny so far, we're talking about here is Jan 1 through September 30th. October's largely been a repeat of that same time period in terms of kind of these trends. November's reversed that a little bit. But what it essentially comes down to is if you, as an investor, made a choice between buying a profitable company and an unprofitable company, if you bought the profitable company, you were wrong. If you made the choice to buy a company that had revenues versus no revenues, if you chose revenues, you were wrong. And that's in the NASDAQ, that's in the S&P, that's in the NASDAQ, that's in small mid-cap stocks. So, and we make you bounce around a little bit, but we'll work our way on this chart from left to right. So if you just said, you know what, I'm going index fund, give me the QQQ, you would have been happy with performance so far this year. But if you then made that distinction and said, give me all the stocks that trade in the NASDAQ, but give me the ones that have no revenue, those are up 34% for the year. If you instead said, give me the NASDAQ companies that lose money, they're up 18% for the year. Give me the NASDAQ stocks that have revenue, that actually have sales. They're up 11%. But let me be even more discerning and say, give me the NASDAQ companies that are actually turning a profit. They're up 7%. So if your choice between no revenue and making money in the NASDAQ was a 27% difference in performance so far for the year. That's the domination we've seen from unprofitable and, negative, no revenue companies. Now let's pick on the S&P 500. If you own the Mag 7 so far this year, you were happy, you're up 18%. If you instead owned the S&P 493, you were up 8. So again, continued domination by the Magnificent Seven through the end of September. And then if we go into the small mid-cap world, so this is going to be the Reinhardt part of the portfolio, Legacy Clarkston that has since been terminated and was consolidated into the Fidelity Extended Market Index Fund, which is our passive exposure to everything but the S&P 500. It's primarily small and mid-cap names, but there are still some large-cap stocks in there. Because one of the distinctions with the S&P 500 is it's always thought of as the 500 largest names, and it isn't always the 500 largest. It's the 500 largest profitable companies, right? There are certain quality restrictions that the that Standard & Poor's puts on the publicly traded stocks that make it into that. And the most famous example would be Tesla, right? We owned Tesla for a long time in the Fidelity Extended Market Index Fund, and until it met quality requirements to graduate into the S&P 500, when it finally made it in, it was a top 10 holding. So in small mid-cap, if you said, give me the unprofitable ones, those were up 12% so far, 9 months into the calendar year. If you instead said, give me the profitable small and mid-cap stocks, they're only up 5. So unprofitable small and mid-cap names up 12%, profitable small and mid-cap stocks only up 5. So I've used this to lead into, normally when we talk about individual managers, they own JP Morgan or they owned Apple or they didn't own enough NVIDIA. In this case, for the third quarter and so far for the year, the line is simple. If you had a focus in your portfolio on companies that sold something and sold that thing at a profit versus buying companies that didn't sell anything and lost money, you underperformed. So any decision to say, hey, I want to be with the one that's making money was the wrong choice. Jumping into the book, I always think this is a great reminder. Take you right to page 3, the mountain chart. Right, the Township made the decision years ago, and this goes back to 2014, to trade an uncertain liability for a certain liability, right? You bonded, issued debt to fund the pension obligation. That's arbitrage, right? The idea is, and I'm not really sure where we are from an interest rate, but even if it's at 5%, which I think is probably pretty high considering it was issued back in 2014. Right. I always think the number in the bottom right-hand corner is the immediate test of, was this the right decision? And as long as that number in the bottom right-hand corner is higher than the interest that we're paying on the debt, this was successful. Now, I don't know what the number is on the debt, but I promise it's less than 3. Okay. I don't have to be very good at math to know that 9 is a lot more than 3. Yeah. So this has been, without a doubt, a wise and profitable, unlike the equity markets that have been rewarding unprofitable decisions, this has been a profitable decision and a prudent decision for the Township. And I always, the numbers here are always kind of staggering to me. Now remember, this is related to the equity portion of the pension portfolio, right? The contract with now Empower is outside of this. Collectively together, the two portfolios represent the pension, but this is the power of the equity markets. Back in 2014, that was 11 years ago, 84.1, call it $84.2 million value. We've had net cash flow out of $34.3 million. That is money being transferred over to the contract to either pay the MIFL or pay benefits. What does a 9% annualized return over that 11 coming up on 12-year time period mean? $79.7 million in gains, right? That's stock price going up, that's dividends, that's interest, that's capital appreciation. So we could end the conversation right here and say, was that decision successful? Yes. Does it continue to be successful? Absolutely. But I can't stop the conversation there because I spent all this time leading into talking about performance. So let's jump to page 4. So as I'd mentioned, good, not great. What's the distinction there? Well, positive news, but not as good as it could have been. The overall equity portion of the pension was up 6.68% for the quarter compared to the policy index, which would be, right, if we just said, forget about active management, and we just bought index funds, was up 7.35 for that same time period. So as I'd mentioned, that crazy notion of I want to own profitable companies, not unprofitable ones, didn't work so far for the quarter. The one that bucked that trend a bit was Ancora because of their exposure to Broadcom and a few other names. Ancora was up just over 6% for the quarter, ahead of index and ahead of peers. Fidelity S&P 500, no surprise, up 8.12. Reinhardt with their small mid-cap portfolio, up 5.8%. As I've mentioned, normally we'd go into individual names and say it was this bank or that bank. That wasn't the case. They own 38 high-quality, profitable companies in the portfolio, and that just hasn't been rewarded so far for the year. Fidelity Extended Market Index Fund. So this is U.S. equity market minus the S&P 500, own everything else. As I'd mentioned, predominantly small and mid-cap stocks, but there are a couple of large-cap names in there. The historical, well-known one was Tesla, up 8.9%. The change you will see from this page for 9/30 to this page for December 31st is working with Michael through the month of October. On Halloween, we funded a new allocation to a small mid-cap manager called Siegel, Bryant & Hamel. About a $12 billion shop based in Chicago, purely focused on U.S. equities. Great complement to the Reinhardt portfolio. No overlap. They outperform and underperform at different times. Overweight and underweight different sectors. We kind of viewed it as a great addition to the portfolio. Had a long conversation with their portfolio management and research team to kind of make sure that Michael was comfortable with it. And that was funded in the pension portfolio and the retiree healthcare portfolio, and they went live October 31st. So when you see this page in February of next year, can't believe that's only 3 months away, you'll see a new name added onto that. We think great entry point. They've underperformed in the last 18 to 24 months, not to a huge degree, but just any type of quality focus, as I'd mentioned, has been punished. It has continued to be the right move to move away from Clarkston. They've continued to struggle. Underperformed significantly in September and in October. We had already been out of the portfolio prior to that. Jumping to page 5 and round things out with the rest of the portfolio. From an international equity standpoint, continued strong returns. International index up 4.6 so far for the quarter. It's up mid-20s on a calendar year-to-date basis. ABS with their emerging markets portfolio up 10.5% for the quarter. They're up, it's not on here. We have a fiscal year-to-date column rather than a calendar year-to-date column. But on a calendar year-to-date, they're up north of 30%. Emerging markets is just absolutely dominated. And recall that ABS portfolio is a little different. I know there's been concern about tariffs. One of the reasons that we think so highly of that portfolio is while they're focused on emerging markets, they build that portfolio with, I think there's 25 underlying local specialists. So while that team is based in Connecticut, they travel the globe looking in country for the best long-only equity manager. So much the same as, right, we think Ancora is one of the best. We think Reinhardt and Siegel, Bryant & Hamel, being U.S.-based investors, are the best U.S.-based equity managers. They're in South Africa finding the best South African-based South Africa equity manager. The idea being is understanding the local cultures and everything else, right, versus sitting at a trading desk in New York and saying, well, I was in Vietnam last year, and I think this is what's going on right now. They are hiring in-country specialists. So what they end up with is exposure not necessarily to the top 10 names from an emerging market standpoint. They still own those, but much more of a focus on small and mid-cap names. So it's less about exports and more about local trade for a lot of these companies. So much the same as we have a lot of exposure to small and mid-cap stocks in the U.S., that do much more domestic trading, they're owning, names in South Korea that are trading domestically, right, within their own borders. So that's been a great benefit to that portfolio. Now we move into the zeros, just from a timing standpoint. The only thing we've had report so far in real estate and private equity has been principal. Seeing a nice turn there. TerraCap has been struggling, just a function of, purchasing in 2020, 21, and early 22, really peak values from a real estate standpoint and working their way through the interest rate cycle. They've been aggressively working on lease renewals and lowering insurance costs and everything they can do to protect the portfolio. But that is down, since it started back in 2021, effectively 16%. So that's something there's still time to work through, but it's going to be a negative mark in the portfolio, I think, for a little while.
That's not a cash loss, right? That's a mark to market.
It's a mark to market, correct.
So, do we anticipate that as they exit from their investments and actually return cash, is it still likely that they're going to return 16% less cash, or do we think that they're going to they're going to make that money back up?
Let's separate hope and reality.
Okay.
Right? The hope is, the reality is, to the extent they're able to keep the buildings leased up, keep lease rates up that make refinancing attractive, we'll be fine. But if we have any issues with leasing, if rates move higher and they have to refinance something in 2027, and if rates go any higher from here, prices are going to come down further from a commercial real estate standpoint. Residential real estate has bucked that trend.
But they're not in that.
They're correct.
They're multifamily, but they're not.
They're in apartments. Yeah, but apartments are still classified as commercial.
Right.
The reality is, I would say, if we get back to zero, I think it's been a success.
Okay. And so, do they have a term that they have to liquidate their portfolio, and then, or can they move into a continuation vehicle? What are the options?
So, fund started in 2021. Typical life is 8 years. So just normal run of business, this is 2029. So that's, 4 years from now. So that's still plenty of runway for them to continue to work on improving things. And, if we get to the Goldilocks scenario of long-term rates come down, the news is going to get better quickly. So 8-year fund life, 2 1-year extensions at their discretion, and then if there's still properties that they think, holding this is beneficial, that's when we would see a manager like this would come to the limited partners and say, we're seeking limited partner requests for a 1-year extension of fund life, and these are the reasons why. And these are the economics that we're going to offer you to incentivize you to allow this to continue on. So it's a long answer to saying we're halfway through, an 8-year expected life, so there is still plenty of expected time left in the fund. But what's hurt them has flat out been not a misstep from their standpoint, but just the reality of rates rising in calendar year 22. You can't have the 10-year go from 1.5 to 4.5, tripled. That's pushing commercial real estate prices down. So for them, it all comes down to a mark to market. The other piece I'd say is impacting them is, appraisals that they're using are based on recent comps, and recent comps don't necessarily reflect a Class A high quality seller. They represent a seller that is upside down in their mortgage and had to sell the property, not wanted to sell the property, was forced into it. So that's artificially keeping the appraisals that they're using down. And to be clear, they're using third-party appraisers. Everything is done December 31st. So they did this 12/31 of 24, and then through 25, each quarter, they take 25% of the portfolio and reappraise it. So over the course of the year, everything's been reappraised. One thing that they do differently than others, we see this with other managers, like, hey, if I own 3 apartment buildings in Phoenix, I don't have all 3 of them appraised at the same time. I do, right, one in March, one in June. As you'll see managers like, oh, if I appraised one property in March in Phoenix and it was up 5%, I'm going to take my other 2 and put them up 5%. TerraCap's position is, if I appraise it, that's the one that's impacted, right? So that may,
Cash flow from it? Are they sending out any dividends, or is it?
no,
No.
they're doing what they should be doing, which is we're holding cash back to make sure that we can meet debt obligations. If we need to do tenant improvements, like anything we can to make sure that we protect, the individual properties as much as possible. The other piece that they do, and this is really from a fund strategy standpoint, is, the leverage that they use, right? The mortgages are a property by property basis, not for the fund. So if one property is upside down in a mortgage and has to be foreclosed, it's siloed. So, one property doesn't sink the fund.
Right, so I just wanted to emphasize for the committee that even though these are scary numbers, this isn't actual cash losses. These represent
It's all paper.
it's a paper loss, it's a mark to market of what those assets are trading at today. You mentioned the distressed nature of some of those trades. And so we're looking at this, that we've got at least another 4 or 5 years of holding this investment, and hopefully they can bring it back so that our internal rate of return is at least 0.
Correct.
So that we're not going to live.
And to put more sugar on it, it's only 1.4% of the portfolio. So
Exactly.
It's
Yeah.
not a good thing, but it's not dragging the
It's
portfolio.
not 10% of the portfolio.
Right.
Right.
Yeah. And to quote the chairman, we'll finish with some sugar. How about that? Capital Dynamics, right? So private equity secondaries fund. So they're going out and purchasing existing private equity funds at a discount to fair market value. As I'd mentioned, I think it was the last meeting, we didn't have pricing yet in it, but if you look, bottom right, almost bottom right-hand corner of page 5, from October, right, so 1 year in, that portfolio is up 30.5%. Now, the risk of taking away from some good news, I feel the need to level set expectations. The goal for that fund over its life is like a 15. So great right out of the gate, but expect that number to come down a little bit. And that's simply from the standpoint of, right, if this private equity fund is worth $100 and I need to sell it because it's an illiquid fund, I'm not getting $100 for it. I might get $70 or $75 for it. So if Capital Dynamics purchases it from me at 70 and it's really worth 100, well, by the time I bring it onto my books and finish that sale transaction and then have it marked to market, guess what? If it was worth 100 last quarter and nothing's changed, it's worth 100 this quarter, I now have the benefit of that immediate write-up. That's part of the beauty of investing in secondaries, is you get that initial pop out of the gate because you're purchasing it like every good Midwestern person appreciates, right? Like, I got it at a discount. Let me tell you the sale that I got on this thing. Costco has heated vests for $40 that my wife was really excited about. So, and on a good note, that performing really, really well straight out of the gate.
Any questions for Brian on that piece of the portfolio?
Brian, do you want to address page 6, the allocations?
Yep. So, as we look at September 30, we were overweight both U.S. large cap and overweight international equity. Both of those, with the addition of Siegel Bryant Hamill to this portfolio that went live on October 31st. And that last week of October, we worked with Michael to rebalance the portfolio and now bring each of those back in line with their long-term targets.
But we're still underweight real estate and alternatives.
Mm-hmm. Actively working on some alternative investment options. But because that is a long-term commitment, I was going to say marriage versus dating, but right, because that's a 10+ year commitment, very deliberate, very considerate about who that partner is. but within the next week or so, I'll have some other options in front of Michael for his consideration.
And we have still some capital that is yet to be called to Capital Dynamics.
Correct.
There's probably another, what would you say, $600,000-700,000 there that is yet to be called. So that'll increase closer to about 2.5 million. Right now it's at 1.9. Real estate, we're fully funded. And Brian mentioned the small mid-cap. We have the new active manager in there. I'll save for number 7 when we talk about allocations.
Okay. Defined contribution plans?
Yeah, so our 401 continues to grow, again, with great returns based on the investments in the market, as well as the contributions that we're putting into the plan on behalf of the employees. The 457 plan is also seeing solid returns. Typically, we look at the fund lineup in those plans once a year, unless Rob Higgins from Schwartz and Company, unless he identifies something that we need to take action on sooner. The one update I'll make to the committee is that we changed the target date funds in those plans to index select through TIAA and BlackRock. BlackRock's the asset manager. TIAA offers the lifetime income option through that plan. So now our 401 and 457 members or participants, when they retire, can choose to convert some or all of their assets into a lifetime income stream, like a pension. And this stemmed from the conversations we had with employees where everyone said, hey, we want to go back to the pension, we want to go back to the pension. For the township, that's just not economically viable. So we found this alternative that you continue to accumulate assets into your 401 or your 457, and then when the time comes when you're ready to retire, or even after you retire, you can make the decision. You can convert some or all of your assets into a lifetime income stream through TIAA basically you're annuitizing, but you're annuitizing pre-tax and at a higher payout rate than you would if you bought a retail annuity, say. So it's a great feature. I think it has been it's been rolled out to the employees. I think they've been pretty excited about it. I know I'm excited about it, and so I think it's going to provide us a really good, also a recruiting feature because we're one of the first municipalities to offer this. So anyway, but in the meantime, we tell people continue to invest in your 401 and your 457, allocate appropriately, work with Rob Higgins from Schwartz and Company, and you'll have the option when the time comes if you choose to annuitize. So those are our plans.
Thank you. And the following benefit payments?
Okay, so item 6, as the committee is aware, through the contract with Empower, we have to keep on deposit the actuarial value of the liability in their guaranteed deposit account. This was the contract that was signed back in 1961, and it just doesn't make sense, unfortunately, the way it's written for us to get out of it. We're kind of stuck in it. So what that means is for all of these guaranteed pensions, we have to keep in their guaranteed deposit account a certain minimum funding liability. That's the MFL or MIFL. In the late 2018, 2019, 2020 timeframe when interest rates were really low, we had to constantly pump money into that. That was what Brian referred to earlier when he went through that cash flow chart. So that $34 million moved from this equities portfolio into the guaranteed deposit account with Prudential at the time, now Empower, to fund those liabilities. As interest rates rose, the GDA was earning enough and the liabilities went down, so we didn't need to fund anything, so we could keep all of the money in the equities portfolio. Now, as interest rates are starting to tick back down, we've been notified that we are going to have to make a payment on the minimum funding liability by the end of the year. It's going to be about $2 million. And so we're going to have to take that out of our portfolio here and transfer it over to Empower to put into the guaranteed deposit account. The other thing that's causing that account to go lower is that we're also funding the non-guaranteed pensions, the benefit payments to the newer pensioners out of that fund as well. So we have to fund those newer pensions out of that fund. And so we're going to have to basically start transferring over about $750,000 a month to, is it a month or a quarter? It's a month.
I think
It's a month. To Empower to basically fund the benefit payments that they're making to our newer pensioners. So one thing I wanted to discuss here is that, number one, we've got to make a MIFL payment of about $2 million by the end of the year. So where's it going to come from? And then how are we going to structure our portfolio with this new reality that we're going to have to transfer about $750,000 a month over to Empower to make benefit payments?
And is that indefinitely?
Yes.
And it will keep growing.
And it will keep growing as more people retire.
Yep.
Yeah, we've reached the point now where the monthly payments to the non-guaranteed pensioners are more than the guaranteed pensioners.
What latitude do we have with some of the cash that we have, the 100 million plus sitting liquid? Is there a portion that can come from that?
You're talking about the operating funds?
Right, from a funding standpoint.
So we can't take it from the operating funds
Okay.
because that's township tax money,
Okay,
whereas the money has to come out of the pension plan.
okay.
So we'd have to free up the cash in our pension plan to be able.
Is the plan fully funded?
The plan is 90% funded.
Yeah, about
Okay.
90, 91.
Okay.
We
So
do
we
have.
don't have a funding
Well, we
obligation.
do have to make, we do have an obligation, Jason. How much are we going to have to pay by the end of the year?
We're gonna pay, by mid-December, we'll be putting new money in from operating funds.
From the operating funds.
Of just under 5.5 million. And that's the ADC each year.
So 2 million's covered from cash flow.
Right. So
Starting next year, we have 3 million to start, plus potentially another deposit. I mean, we could almost break even from what the obligation is of what we're gonna be funding from operations anyway. I'm just putting it in my head, I'm not scratching it out,
Yeah.
right?
In some years, because we have that ADC that's been around 5 to 6 million a year, if around that time we're having to make a transfer to meet a MIFL requirement, since you're putting that new cash in, that can be used to cover that MIFL requirement. So
Okay.
it's new cash infused into the trust.
I think it's worth noting, while this sounds like it's something unique, right? It's unique to the township from the standpoint of the contract has been able to cover the non-guaranteed payments from a historical standpoint, but because the non-guaranteed have grown, which is, it's a good problem to have, right? It means that people have had their working careers, people have retired, we're meeting the benefit promise that we've made to those employees, like we're doing all of the things that we're supposed to doing. This exact same thing happens in every township hall and city hall and county building around the state. Just the nuance here is the contract versus the system paying that out.
At 90%, that's beautiful. right?
That's awesome,
And so
yeah.
that part doesn't scare me. What I'm trying not to do is sell something that's earning 9% over time versus something that's sitting there earning probably 3 now,
Yeah.
right? Maybe just under 4. from an allocation standpoint. And so,
Yeah.
you know, and so if some of it can be done through cash flow versus selling the pension, I mean, the stock portion. And it's a good conversation.
Unfortunately, I mean, we're stuck in that contract because Empower requires us to have 102% of the actuarial value of those pensions funded in its GDA. We have to be at that.
No, I.
Minimum level.
I was part of that when we
Yeah.
did the analysis.
Yeah.
So, no, I was just trying to, again, take cash flow that looks like it's almost breaking even with what
Yeah.
we are gonna owe over the years to cover the 700 grand a year, a month, and then we'll have to sell pension, stocks. I mean, but
So-
I'd defer that till we have to.
Yeah, one of the piece that we're working on behind the scenes, and like Jason and Michael haven't even seen this yet, but like we have a liquidity schedule that we prepare for clients that kind of looks out over the next 12 months and says, what do we need? Do you have retirements expected, right? If we, for some plans, like if a firefighter or police officer leaves and they've got their employee contributions, like it can be a big kind of one-time lump sum payment. So just understanding cash flow is, we look out at that. When do we expect the, employer contribution to come in? Is that going to be January? Okay. What does that cover from a cash flow standpoint? And it's fluid. It's something that we use, if you go back to 2021 and earlier when we were earning zero on cash, well, to Dave's point, we want to keep the money working in the portfolio as much as possible because holding cash is a zero revenue for the system versus today when we can make between 3.5 and 4. Okay, we're going to look at this every 3 months and we're going to use this as a mechanism of rebalancing. And these are the cash flow needs for the next 3 months. What's the best place to source those from? Let's take care of that. If rates come down further, then that may be a month-by-month conversation, just in terms of keeping revenue, keeping the money working where we can generate a return versus not. And there's other mechanisms we can flick on of like, our S&P 500 right now reinvest dividends. You know what? Don't reinvest dividends. Pay dividends to us in cash, and we can use that cash flow from the portfolio to help offset liquidity needs. So there's a lot of levers that we can pull to make sure that we meet that. And the plan today isn't necessarily the plan 6 months from now, isn't going to be the same plan 6 years from now. It's going to be fluid and adjust as cash flow adjusts, as market dynamics adjust, and as other things pop up. Welcome to being a mature pension system. You're officially middle-aged, now you have cash flow you have to work on.
Yeah, but the good news, let's not lose sight that we're 90% funded.
Yeah.
That's,
Yep.
what's Illinois? 50, 40?
Not even.
Yeah, so-
And then the average, I can tell you the average plan in the state of Michigan is like 77 or 78% funded. So you're at 90, top of the class.
Yeah.
Yeah.
And sitting with liquidity to be able to help, so. So we don't have to make that decision today, it's just a.
Well, no, I wanted to have that topic discussed and have Brian, tell us, I don't know if you have any ideas at this point as to how, and then that leads into the next item on the agenda, which is allocations. Like, are we going to do we need to modify any of the targets to increase, like right now we have a 0 target on cash. Do we need to increase that to 3%? Do we need to increase that to 5%? Do we need to have a fixed income allocation so we make sure that there's enough cash there to support? I don't think we need one, but I'm open to it. I'm just, do we need to change the allocations? Because if so, that has to go before the Board of Trustees. So and we as an advisory body would make that recommendation.
Yeah, what I would like to understand, and maybe in a working session, is how we can do that. Is what cash flow are we typically putting in, Jason, on an annual basis? And then, so that's gonna help with it. What do we have to support, right? And then, should we have a short-term duration, 2-year duration fund in there earning 4% for backup? So I'm just making that up, but.
Yep.
Yeah.
I think that's all. Look, and we checked this before. Like the investment policy as it stands has a 0% target to cash, but we can have up to 5%. So if we need cash to make a MIFL payment, like we don't need to adjust the policy to be able to handle that. And to Dave's point, expect this on the next agenda, or a working session or something else. But like there needs to be a deeper conversation around this. will likely result in changes down the road. I don't know that it necessarily results in a change immediately, but I want to better understand, we're putting in 5, we're paying out 750, not just back of the napkin math on that one, but work through and so to be determined.
Right.
Okay.
I mean, we do need to come to a resolution because Empower is going to be looking for us to start making payments probably in January.
And there's no flexibility. I know Brian worked, with them to do, let's look at it quarterly, semi-annually.
So I've asked them to say, hey, guys, are you really going to make me pay this monthly, or can we deal with this quarterly? Because again, they're holding a huge cash balance between the GDA and the cushion that they've got because they want 6 months of payments of the non-guaranteed pensions on deposit. So I pushed back and said, can we make that 3 months if I'm going to fund it every month? Like, why do you need 6 months?
Mm-hmm.
So they want 6 months on deposit of those $750,000 a month payments. So we're still working through that. But I'm putting this on the committee's radar that in the new year, we're probably going to have to either a monthly or a quarterly transfer is going to have to occur to cover those non-guaranteed pensions.
Well, noted and work to do.
Okay.
Thank you, appreciate it. So we're not doing anything today, but that may happen in the future under 7 allocations and new
Right.
investments.
Yeah.
Committee changes.
Yeah, so
Number 8.
under number 8, committee changes, I would like to fold the Retired Employees Healthcare Benefits Trust into this committee. And as you may know, we have a 7:30 meeting before this meeting that consists of myself, Jason, and trustee Chris Kolinsky. And we have the same presentation from Brian. It's the same kind of structured portfolio. It seems kind of redundant for everybody. So I would like to bring that trust under the auspices of the FSC. Trustee Kolinsky will step off because we have a quorum issue if he were to join us. And so the goal would be to have this body also act as an advisory, to the trust. And I think Jason and I would still stay as the co-trustees of the trust itself from a legal standpoint. And then the other thing I wanted to recommend is I would like to ask the Board of Trustees to appoint 2 new residents to the committee. I think it'd be great to get some new blood, some new feedback to the board, provide an extra opportunity for residents to get involved in township governance. We have a lot of really smart people out there, and I think that this is one place that we can take on a couple extra people to get some feedback. So get some new ideas, et cetera. So I would expand this committee from 7 to 9, and the board would appoint 2 new residents to serve on the committee. Any thoughts on that?
I think it's a good idea.
Yeah.
I support it.
Good opportunity to bring
I mean,
some.
it's efficient. I mean, I can't take 2 sets of jokes every time I come here, so it's.
Bad jokes to begin with.
Right, yeah. So no, but it's efficiency and,
You're doing the same thing.
Exactly.
Yeah.
If somebody misses, it's apparent, it makes it harder, so.
Could I add one clarification? For the sake of those enjoying this from the comfort of their living room, Michael mentioned rolling in, the Retiree Healthcare Trust is a separate and distinct legal trust, allocated separately, right, different bank accounts from pension. It would stay allocated separately, held in its own bank accounts. It's just the oversight. Right? Sometimes people hear roll in and they're like, oh, you're going to consolidate. No. They are separate and distinct investment pools and will remain that way.
Thank you for clarifying that, Brian. It was certainly not my intention. to imply that we should be combining these trusts or anything like that. No, they would remain separate, distinct, legal trusts, separate accounts, everything would be managed separately. They would have different policy statements, different allocations. So it's just for the sake of, convenience and efficiency, and having, frankly, more eyes on that as well. I don't see that there's a problem. So thank you, Brian, for clarifying that.
Any other questions about committee changes? No. 2026
Yeah,
committee meeting schedule.
so, thank you for that, and I left my piece of paper, in my office. So give me 1 second here. Okay. So for next year's committee meetings, I think this has worked well where we've gone the first week of the second month after a quarter close, right? So this allows Brian to gather all the data that he needs to be able to present to us. The request that I received is that we not hold this the day after elections. And so I'm proposing for next year, February 5th, which I believe is a Wednesday. And then,
February 5th is a Thursday.
It's a Thursday.
is it?
Yeah.
Okay.
I already have it in my schedule. You must have had that.
Okay, so I must have already said it. So February 5th, okay. May 7th, which should be a Thursday. May 7th. Right?
Makes
Yeah, I don't
sense.
have it- I don't have it in there.
Well, we haven't put it in yet. I'm just,
Yeah, that's a Thursday, but-
Right, I'm proposing these,
Yep,
okay?
yep, that's good.
August 6th, which should be a Thursday. This way it's 2 days after the election. So we may not have a May election next year, but we might. It's still a possibility, but we definitely will have an August election next year. So this room is being used as a precinct now. So in order to get this set up for us for a meeting after it's being used as a precinct, the clerk's office asked for an extra day.
So what are you saying, proposing for July?
So it'd be August 6th,
Oh, August 6th.
Thursday, August 6th.
Got it, okay.
And then because November is a big election, I'm asking for an extra week to November 11th.
That's a Wednesday,
That would
Veterans
be
Day.
Wednesday, November 11th.
It's Veterans Day, if that means anything for anybody.
I mean, we're open.
Okay, I just want to make
Does
sure.
anyone have-
I'm good with it.
The markets are closed, right, Veterans Day?
Yeah.
Okay,
Yep.
so November 11th, okay? All right, so the dates, February 5th, May 7th, August 6th, November 11th.
Got it. Okay.
And is somebody going to send out a?
Yes, we will.
Thank you.
We will. Okay. That's all I got.
That's it. Any other business by chance? Hearing none, we'll adjourn the meeting at 8:48.
Thank you.